Hello financial fans, welcome back to another stock analysis. Today we'll be covering Advanced Micro Devices, stock ticker AMD. AMD is a multinational semiconductor company that designs and produces microprocessors, graphics processing units or GPUs, and other computer hardware. AMD's main business is the production of central processing units or CPUs for computers and servers, as well as graphics cards for desktop and laptop computers. AMD's processors compete with those made by Intel, another major player in the semiconductor industry. AMD's processors are known for their high performance and competitive pricing. In recent years, AMD has made significant gains in the CPU market, with its Ryzen line of processors offering excellent performance at reasonable prices. AMD also produces graphics cards, which are used for gaming and other graphical applications. AMD's Radeon line of GPUs compete with Nvidia's graphics cards and is known for its excellent price-to-performance ratio. The company is currently sitting at a market cap of $133 billion, and in 2022, they generated a revenue of $23.6 billion. 33% of their revenue comes from client computing, 25% from gaming, 22% from data centers, and the remaining 20% from embedded. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 20%. It says 25% in the slides, but that's incorrect. We'll be using 20% in our valuation, and the margin of safety can never go below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. Over the years, the EBIT of AMD has gone up, going from $127 million in 2017 to $1.2 billion in 2022, with a peak in 2021 at $3.6 billion. The average EBIT growth is 102.6%, meaning a 10% deduction in a margin of safety. The margin has also grown, going from 2.4% in 2017 to 5.3% in 2022, again making a peak in 2021, sitting at 22.2%. The average margin growth is 50.9%, meaning another 5% deduction from a margin of safety. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For AMD, as you can see on the top left, they have more cash than they currently have debt, meaning that they can pay off all of their debt just using that cash. This indicates a 0% debt to EBITDA ratio because AMD has no net debt, which is a 5% deduction from a margin of safety. The return on invested capital for AMD is sitting at 3%, which doesn't qualify for a margin of safety deduction, so no change in the margin of safety on this metric. Looking very good so far for AMD. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of AMD going from 2019 to 2022. The annual growth rate on average in their free cash flow was 168.88%, and I'm projecting an expected growth rate in the future free cash flow of 15% annually for the next 10 years. With this percentage, we can determine the future free cash flow of AMD and determine a terminal year of valuation with a perpetual growth rate of 3% and a discount rate of 9%. This gives us a sum of free cash flow of $133.2 billion, and all that's left to do to get an equity value is to add the cash and equivalents and subtract the debt, giving us an equity value of $136 or $136.2 billion. All that's left to do then to get our discounted cash flow price per share is to divide it by the amount of shares outstanding, giving us a price per share of $84.65, which is a 2.39% upside from this model. The second model that we use is Graham's valuation formula. In this model, we look at the earnings per share that AMD is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, sitting at 4.4. And we go by the theory that a company with no growth always is sitting at a PE of 7. Looking at all of these metrics, we get a fair value of $38.54. Keep in mind that this is a very conservative model, and this leaves us with a downside from this model of 53.38%. The third model that we use is the multiple valuation. In this model, we look at similar companies to AMD, look at their stock price and their earnings per share. In this case, I've only chosen for Nvidia to compare with, and this gives us an average PE multiple of 96.26. All we have to do to get a fair value out of this model is to multiply by the earnings per share that AMD is generating, which is 82 cents a share, giving us a fair value of $78.94, which is a 4.5% downside out of this model. And the last model that we use is the mean reversion theory. In this model we go by the theory that a company will always trade above or below its mean, and the metric that we use to determine this is the PE ratio. In this case, I've imported the PE ratio of the past 5 years, and on average it has been sitting at 78.69, with the current PE ratio sitting at 101.81. This means it's currently overvalued on this metric, and this gives us a fair value of $63.89, which is a 22.71% downside from the current price out of this model. If you want access to all of the models that I use in my videos and more, you can check in the description for my Patreon link. Anyways, getting its self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at the final overview, we've imported the discounted cash flow, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $66.50. Our margin of safety we've determined earlier, using a standard margin of safety of 20%, deducting by 5% for the debt to EBITDA, 10% for the EBIT growth, and 5% for the margin growth, leaving us with no margin of safety. Then, with the fair value of again $66.50, with the current price of $82.67, we get a downside out of our valuation of 19.55%, indicating that it currently would be considered a sell. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.